Estates Ask the Experts, produced by Trust and Estates and wealthmanagement.com. Today's session is titled Donor Advised Funds versus Private Foundations and is sponsored by Foundation Source. My name is Anna Sulkin-Stern, and I'm the legal editor at Trust and Estates magazine, and I will be your moderator today. In a moment, I'll be turning things over to our speakers, but first, let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you will find multiple application widgets. Clicking on these icons will allow you to open and close widgets on your screen, but will not remove you from the event. A copy of today's slide presentation is available for download on the resource list widget. Today's presentation is a special Ask the Expert session. It will follow a slightly different format from our regular webinars. The speakers will first give a brief presentation. They will then answer pre-submitted questions. If time permits, we will open the floor up to live questions from the audience. Feel free to submit yours to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the submit button. Please be aware that today's session is being recorded and will be available for on-demand viewing following the event. Simply log in using the same URL that you're using today. Now, let me introduce today's speakers. Jillian Howell is the head of Client Advisory Solutions at Foundation Source. Sandra Swirsky is the founder of Integer, and Gregory W. Baker is president and chairperson of Renaissance Charitable. You can find more information about today's speakers by clicking on the speaker bio widget at the bottom of your screen. With that, let's get started. Greg, the floor is all yours.
Well, thank you, Anna. I'll begin with a brief introduction to donor advised funds, or DAFs. My topics will include some key definitions, and then we'll take a brief look at how and why donors use DAFs. I'll wrap up with some recent statistics, and of course, these slides and more are part of the handout available to you. True story. I was on a phone call with a donor a few months ago, and he said, I want to fund my fund with funds from my fund account. This illustrates that it's very easy for donors and professionals to use the term fund several different ways in the same sentence or thought. And it's very clear to the speaker what they mean. It's just not nearly so clear to the listener without a translation. And of course, what this donor meant was, I want to make a charitable gift to my donor advised fund with shares of a mutual fund from my investment account. Got the wrong slide here, I'm sorry about that. So the first thing to know about donor advised funds is that the donor advised fund itself does not exist as a separate entity. Instead, when we say that a DAF is created, we mean that the donor makes a gift to a sponsoring charity, and that charity agrees to track the donor's contributions, investment performance of those assets, and also to accept recommendations from the donor regarding potential grants and also possible investments. As grant recommendations are approved and paid to another charity, then the DAF's assets will correspondingly drop in value. And of course, as investment performance goes up and down, the DAF value will also go up or down correspondingly. Donors are eligible to claim a charitable deduction for gifts they make to the donor advised fund. And if the gift is made during life, it's an income tax charitable deduction. And if the gift is made at death, then it's an estate tax charitable deduction. And finally, because the sponsoring charity owns the assets, the investment returns of a DAF are generally going to be tax exempt. Some of the reasons that donors love donor advised funds is they can claim the highest possible income tax deduction, with the minor exception for conservation easements. They avoid capital gain tax on any asset contributed to the DAF's sponsoring charity. Now, obviously, the avoidance of capital gain tax presumes the donor completed a free will gift to charity and that the donor did not previously agree to sell the asset they contributed, such as what we've seen in some recent court cases, such as the estate of Hohenscheid, Krim v. Commissioner, Kiefer v. U.S., and Lim v. Commissioner. Donors can use nearly any creative name they can conjure as the name for their donor advised fund, ranging from the basic John and Mary Smith DAF to something more anonymous, such as the Phoenix Fund. I'm highlighting here with my mouse And just a curious question here. Do you know what you call a mouse that swears? Well, that would be a cursor. Well, the DAF sponsoring charity generally agrees to a certain fee schedule that it will assess to the DAF's assets, and then the DAF's investments are charged to an investment management fee. But otherwise, the DAF does not get charged for the costs of running the sponsoring charity. Overhead costs that are included in these fees include the comprehensive IRS Form 990, applicable state returns, state charitable solicitation compliance with the 40-some states that require some kind of specific compliance. And most DAF sponsors also pay for audited financial statements each year. The title of this slide is 8 Ways That Donors Use DAFs, but most of these also apply to a private foundation. And I'll leave that topic for Jillian to unpack a little bit more in just a few moments, but let's take a look at 2 of them on this page, number 1 and number 5. We see many grandparents setting up a donor-advised fund, and then when the family goes over the river and through the woods to grandmother's house at Thanksgiving or Christmas, the grandparents set aside a 15 to 30-minute time slot with each grandchild to talk about the charities they mutually want to support with their DAF. In some cases, the grandparents have created a single DAF that will be the source of all grants they discuss with all the grandkids. In other cases, the grandparents have created a separate DAF for each grandchild. In the latter situations, when Johnny walks into Grandma's office, they pull out the latest DAF statement for Johnny's DAF and discuss it with Johnny. And then John leaves the room and Mary walks into Grandma's office and they pull out the latest statement for Mary's DAF and discuss that with Mary. In other words, they create a separate DAF with each grandchild's name on it. This lets the grandparents and the specific grandchild have a focused conversation around charitable giving, how to read an investment performance statement, which charities to support, and why specific charities matter to each person. Item 5 is for procrastinators. I continue to be shocked at how many times I get a call from a financial advisor in mid to late December that starts out, Greg, my client found another $1 million of income this year and needs a big deduction, but they're not sure which charities they want to support. Well, luckily, a donor-advised fund can be created in less than an hour, and this lets the donors claim the charitable deduction they need in the year of the extra found income, and then make a more relaxed decision next year about the charities that they want to support. A few simple statistics about donor-advised funds. Just about any way you slice the DAF industry, DAFs are on the rise, from contributions to grants paid to DAFs to the total number of assets under management to the number of donor-advised funds. I've provided several other statistical slides in the handout that I won't cover during this session, but as I hand over the baton to Jillian, I'll leave this slide up as a simple overview of 7 different key characteristics of donor-advised funds and private foundations. So Jillian?
Right, thanks, Greg. Here we go. So it really is all about getting started with your goals. So you're starting with convictions and beliefs, how we might change the world, or our clients might change the world. And those values are our guide stars, and they kind of guide the choices that we make. And really, for being in the business as long as I have been, over 30 years, the most satisfying and fulfilling philanthropy begins with those deeply held values, and they then convert themselves into action. And as an individual or a family gets more deliberate in their approach and more strategic, there are different vehicles that can help them do that. Obviously, today we're going to focus on donor-advised funds and private foundations, but I just wanted to show you the kind of spectrum here. And then just starting here, an overview of charitable organizations. Not going to go into, we all go into it much, but we all lie under that 501c3 umbrella, and the public charities, you know, that is where the IRS gives the most leeway. The 509A1 are those kind of, churches, universities that are just supporting public activities in a very obvious way. Other ones are support organizations. And then on the left-hand side, you have private foundations. And there's a lot more that goes into it, but I wanted you to see where both of us lie. And of course, the donor advised fund, as Greg said, lies under that public charity. If you look on the creation of a private foundation, trust versus corporation. I mean, you're going to have the majority of them are set up in a corporate form, not trust form. Trust form I've seen used where, you know, a client is at the end of her life. She's not passing it on to anybody, and she wants a fiduciary to manage her trust, and she wants the mission and whatever she determined her grant making to be in perpetuity and not changed in any way. If you set up under corporate structure, you can actually make some changes to that mission. But also, you know, we can do this. We definitely can't do it in an hour for a donor advised fund, as Greg said. But if you're working with a group like Foundation Source, where I work, or another partner organization, we can set up a private foundation now in less than a week and have you up in grant making as soon as it's funded. So because we take on all of that administrative burden from you, including filing that 2023 application, getting that determination letter. You have 27 months from the date of your incorporation to file that 1023, but we obviously file that immediately. And then I just wanted to say the new accounts or new foundations are pretty obvious, but there's many existing accounts out there, existing foundations out there that are kind of languishing and kind of could have some life injected in them. They're maybe not satisfied with their grant making, not satisfied with the impact they're having. They'd like to involve their next generation more. And that's something that you can get a lot of help with too if you already have a private foundation. Here's some activities for private foundations. Especially with grants, you can do some very complex things around international. You can give to individuals. I'll go into it a little bit more. Many expenses can align against your 5% distribution, but also can just, you can actually are permissible activities within a foundation. And you can do direct charitable activities. And that's really kind of running programs within your foundation, such as educational symposiums, or, you know, we have a client that creates documentary films within his portfolio as well. And then investments, obviously, you know, we're bound to grow and sustain those foundation assets. That's what the foundation is about. But there's other things you can do within those investments, and program-related investments is a very interesting area. And essentially, you can give a loan to a public charity, usually a no-interest loan. And it can be hugely helpful. They pay back that loan, the charity pays back that loan, can be reinvested in another program. So very, very, very commonly used and can be complex, but it's something that a foundation can do for you. And then taxes, obviously a 990 PF, a public document, it's filed every year, and estimated taxes are paid. 1.39% is the tax rate for a private foundation. So it's not tax-free, it's on the taxable investment income, but it is quite nominal at the same time. I'm going to just touch on compliance because it's important, because it does override or has a big impact on private foundations. So minimum distribution, 5%. Investment charges do not go against that 5%. I think that was one of our questions. I wanted to answer that and go into more detail later. But it's made up of expenses, or you align against it. Obviously, grants align against it normally, but also lots of administrative expenses, attorney expenses, site visits expenses can be aligned against that 5%. So you can get there not just by traditional grant making. That's important. The IRS frowns upon foundations being active business owners, so no more than 20%. You really don't see any kind of any foundations. Too many of them I haven't in my lifetime anyway. Going afoul of any of this, and also jeopardizing investments. But it's really about good stewardship, no wildly irresponsible investing, and diversifying your assets. That's what the IRS would like. This is an area, the disqualified person, which is, you know, it's self-dealing, lots of penalties for this, lots of oversight by the IRS on this. So it's a kind of an area that you really do need to partner with somebody that understands this. And it's basically the insider or the disqualified person cannot get any benefit from the foundation. It says here, if you go down there, compensation, you can actually compensate directors, but it does have to be a reasonable and necessary expense in furtherance of the charitable activities of that foundation. But you can do that, but there's lots of things you cannot do because you cannot get any benefit from it. And there's many, many people aligned with the foundation that we would call a disqualified person. Compliance here, taxable expenditures, political activity. I mean, on the face of it, no, but obviously if it's to do with the foundation's existence itself, like the tax benefits of it, there's an advocacy maybe around an educational program. You can provide nonpartisan info. So we do see advocacy most certainly done on Capitol Hill. On behalf of foundations there. Grants to individuals, which is another thing that can only be done in a foundation. We in Foundation Source filed with the IRS and created a program for our clients where they could give to individuals for financial hardship, medical emergencies, hardship relief, hurricanes. And underneath that program, we got approval, and so we decide if it's okay to submit, and we help our clients do that. Any client can do it. They just have to file with the IRS for approval, but it can be done. Other granting to any organization other than a public charity, you can do it, but you have to complete what's called an ER, or expenditure responsibility. Basically, you've got to collect, do a significant pre-grant inquiry, collect the information, customize an agreement, and the charity has to produce annual reports on that. But again, it is doable, and it is a very frequently utilized. Just hear about the similarities. We touched on that a bit, but everyone gets an income tax deduction slightly different. You can avoid capital gains, obviously, with appreciated assets and others. Exempt from gift and tax. It is all around tax advantage, asset growth. And then, of course, once you give that gift both to the DAF and to the private foundation, they're irrevocable. You can't actually bring them back. Drag them back in any way. And then I think interesting here, what is the kind of upside to a foundation? And we can talk a little bit more through that in the questions. But this kind of facilitates intersectional work, spanning policy, impact investing, and grant making. We saw that really clearly with a client that, funded a research study to lobby about paths for access to college, to community college in particular. And they wanted to effect some policy changes around that. And they created this kind of civic mapping research study where funders they themselves came from higher education, and their key, they're identifying key issue and a kind of a plague that darkens that space is access for underrepresented population. And they found weirdly enough that the last mile of a underrepresented population getting to the community college was the most difficult. And they found by just adding a bus route solved it. We didn't have to do no construction was necessary, no trains, no underground metros or anything like that. And it improved the access by 78% in the area that they did that civic mapping. So kind of interesting. So it brings all of that kind of policy work together, impact work together. I talked a bit about mission-driven investments, DCAs, which is those direct charitable activities, the fact that you can run all your expenses through your foundation. I think it is a complement to social entrepreneurship for sure. Business, you see the younger generation, they start businesses, they're purpose-driven, and they continue their purpose-driven business through their philanthropy. So they have, kind of a common brand, both in their business and in their philanthropy. So I think I raced a little bit through that, but I'm hoping that we can go to questions and after we hear from Sandra. So thank you. Sandra, we can't hear you.
Hello?
Yep, we can hear you now.
Okay, good. Thank you. I'm going to talk through the policy and politics around private foundations and donor-advised funds. I think it is a variable that enters or should enter into the calculus when advisors are discerning whether to advise a private foundation and or a donor-advised fund for their client. And so just to begin with kind of an overview, for sure, up until the present time, Assets in private foundations far dwarf the assets in donor-advised funds. And the reason for that is because we've had private foundations for so much longer as a charitable vehicle and a charitable tool than donor-advised funds. But currently, DAFs are exploding in popularity, and I think you probably got that a little bit from Greg's presentation. They are a flexible tool. They're easy to set up. They don't have some of the strictures around them that private foundations have. And as a result, we've seen dramatic growth in donors choosing to either start with a donor-advised fund or to add a donor-advised fund to their charitable giving. And over the past couple of years, we've seen dramatic growth in kind of four key metrics that National Philanthropic Trust has followed, and that is the number of grants, the value of those grants, contributions to donor-advised funds, the assets under management in those funds, and then the number of accounts. Looking specifically at some of those metrics from 21 to 22, I just put up some of these increases, which are pretty eye-popping. We are not seeing this type of growth in private foundations for sure. We are seeing a much more robust interest and increase in donor-advised funds. And it's not just donors and their advisors that are finding donor-advised funds to be so appealing. But recently, in the past 4 or 5 years, there has been a lot of criticism around donor-advised funds, and lawmakers have picked up on that. And I saw a lot of questions pre-submitted around this concern. So critics have kind of hit on a couple of arguments, a couple of concerns around donor-advised funds. I think those on the political left view the work that's being done by, particularly in the policy space, that is running through donor-advised funds as particularly awful. Same goes for those on the right, and some of the policy issues that are being lifted up and supported via DAFs on the political left side of the equation. So it really has become not necessarily a political football for the political right or the left, but we do have members and lawmakers, powerful members and lawmakers on both sides of the aisle, pointing at donor-advised funds and saying, I'm not sure I like what's happening over there, and I'm not sure I like what's happening over there. The other criticism that we hear is that there is no mandated or required grant making or payout from donor-advised funds. So donors get a deduction, a charitable deduction in some cases, or an estate tax deduction in other cases on the way in. But there is no requirement that in a certain period of time that those funds are released to their intended charities. While they are in a donor-advised fund, they are at a charity. They have to be at a charity. And I think that there are plenty of donor-advised fund sponsors, whether they are community foundations or single mission donor-advised funds like through the Knights of Columbus or National Christian Foundation, or at some of the national donor-advised funds that view their role as helping those donors that are having a more difficult time grant making out of their donor-advised fund. They really use their and really take their role seriously to help those donors make those strategic decisions and make those impactful decisions. So there, speaking of critics, there has been a growth, and certainly I'm sure you've seen a lot of the headlines around some of the critiques of donor-advised funds coming from groups like the Patriotic Millionaires, lawmakers have picked up on some of the challenges and have 2 years ago introduced a bill called the ACE Act. Some of those ACE Act provisions made their way into President Biden's budget last year. So I think that that the criticisms and the headlines ought to be taken seriously and considered as part of your calculus when thinking through whether to advise a donor advised fund or a private foundation or both. Let's take a look at the ACE Act and some of those provisions in there. The ACE Act set up really a new structure for donor advised funds. If enacted, it would set up 2 types of donor advised funds. It would keep all existing donor advised funds in place, but it would set up 2 new types of donor advised funds that donors would have to choose from. One would have a 15-year payout. The donor would get a deduction up front, and as long as they paid out what they put in within 15 years. The other option would be a 50-year payout, in which case the donor would not get an upfront deduction, but would take a deduction when those amounts would be granted out. And there's a host of other provisions in there. That first provision around the types of donor advised funds that would be set into place moving forward has probably garnered the most attention. Other provisions in there that also affect private foundations, because the ACE Act isn't just targeted at donor advised funds, but also targeted at how private foundations use donor advised funds. I think Jillian and Greg both touched on how private foundations can use donor advised funds. For example, at the end of the year, they have not yet made their 5% payout. They want to make a strategic grant, but they're not in a position yet to know what that grant looks like. They can put money currently into a donor advised fund, and when that vision comes to fruition, then they can grant it out. That would be under the ACE Act. That would be eliminated. I think the concern there is that there may be some private foundations that are routinely avoiding their 5% payout using donor advised funds. I think what I should have said in the beginning, and I want to make perfectly clear, is that this bill, one of the criticisms of this bill is that it is a solution in search of a problem, that there is scant data to suggest that there is any widespread problem with donor advised funds. And yet, critics of donor advised funds have made headway. And by headway, I mean a bill introduced by members of Congress. One thing to note, though, is that while there was a lot of momentum 2 years ago for the ACE Act, we've seen that momentum dry up. And it is unclear whether the lawmakers, whether the supporters in Congress have been persuaded by detractors of the ACE Act that there is no there, and that if there are problems, they really need to be surgically addressed as opposed to addressed by something as sweeping as this bill. We've also heard that the supporters of this legislation may be retrenching and going back and thinking about a 2.0 bill, taking some of the more popular provisions of the ACE Act and putting them into a smaller bill. So I think it remains to be seen the trajectory for either a new ACE Act or a smaller ACE Act, but it's not something that we necessarily ought to ignore. So I'm going to pause there for questions. Here's a QR code in case folks want to stay in touch, particularly on the politics and policy. And I will hand it back to our very able moderators to moderate some Q&A. Thank you.
Thank you, Sandra. We will now move on to the Q&A portion of the event. As a reminder, to participate in the live Q&A, just type your question into the text box located at the right of the presentation window, or click the Q&A icon at the bottom of your screen. And just another reminder, we will start with the pre-submitted questions, but if we do have time, we will get to the live questions as well. So let's kick it off with the first question, which is for Greg. Are there any minimum distribution requirements like there are in a private foundation?
Well, in a nutshell, no. Donor-advised funds do not have any state or federal requirement to make a minimum grant distribution to charities. However, several DAF sponsoring organizations have agreed with the IRS to make charitable grants of at least 5% of the total value of all the donor-advised funds each year. As an example, Renaissance Charitable Foundation has such an agreement with the IRS and has for over 20 years. But usually that number is reached sometime during the first quarter of each year. So as a general rule, no, but there may be a specific DAF sponsoring organization that has agreed with the IRS to make sure that at least 5% of total DAF value is granted out to charities each year.
Thank you. The next question will be for Jillian. When calculating the 5% annual distribution needed on a private family foundation, please explain how investment management fees are part of the 5% requirement.
Sure. I touched on this in my presentation, but just to reemphasize that custody of assets or asset management type fees are considered not related to charitable activities. And so they don't fall into that qualified charitable distribution. So they are not counted when that 5% is calculated. What's calculated is grants, admin fees, legal fees, expenses, different types of expenses for site visits, etc. You can align those to your 5%, but you cannot align your investment management fees. You can also exceed, sorry, I just wanted to say too, you can also exceed it, the 5%, and you can actually carry it forward for 5 years.
Great, got it. Thank you. The next question is for both Jillian and Greg. Can foundations and DAFs co-invest in funds or companies?
Jillian, how about if I start this one?
Sure.
So yes, foundations and DAFs both can co-invest in the same funds or companies. Both foundations and DAFs, as Jillian mentioned, are subject to the same excess business holding rules. And in a nutshell, these rules limit a donor-advised fund or a private foundation's interest in a company to 20% ownership position, which is reduced by the ownership position of related entities, such as donors to that DAF or foundation, related foundations, related donor-advised funds, and other family entities. It is an issue that we do run into from a donor-advised fund perspective, that we need to make sure that we follow the rules and make sure that we are all below that 20% number. And this is the tax law, so there's loopholes, and each of the loopholes have their own loopholes.
Oh, Jillian, we can't hear you. Do you have something to add?
Yes, I'm sorry. I didn't realize I went on mute. I just wanted to add that you need to be very cognizant of self-dealing here as well, and just making sure you don't get any kickback, any benefit that the insider is going to get, or this disqualified person.
Excellent, thank you. Greg, can you talk about when do charitable trusts make sense?
Okay, by charitable trust, I'm assuming you mean a charitable remainder trust. And these make sense when the donor is seeking a partial income tax charitable deduction for their irrevocable commitment to charity today. And in exchange, the donor and spouse typically receive lifetime income distributions from that trust. So if that's the kind of client that you're talking with, who is okay with just a partial income tax charitable deduction, basically, if the client and spouse have lifetime income for the next 20 years, 30 years, however long their life expectancy is, and then charity receives the money, whatever's left over in the trust, then of course the charitable deduction has to be reduced on a present value basis. That trust is tax exempt, just like a donor advised fund or private foundation would be, but the distributions would be taxable to whoever the named income beneficiaries are. So it's a question of, again, like almost everything else, what is the client trying to accomplish with their stack of money?
Mm-hmm.
Understood. Thank you. Sandra, I have one for you now. How will the new regulations affect PFs that have funds in DAFs, and how will distributions from a PF to a DAF be recorded?
Okay, let me go to my slide here. So the first question Okay. The first question is around the regulations around private foundations, right?
Yes, correct.
And I think that there's right. So in the ACE Act, there were two provisions that caught the attention of the Biden administration. The first provision was the restrictions on private foundations' use of donor-advised funds. And that provision would disallow private foundations from putting money into donor-advised funds to meet their 5% payout. They could put money into the donor-advised fund, but it can't be used to meet their 5% payout. The second provision that caught the attention of the Biden administration was the last bullet here, which is restrictions on family foundation expenses. I think both of my fellow presenters mentioned that there are expenses that can be, quote, run through your foundation. What we've seen is there are plenty of foundations that include family members as staff. In many cases, it's to instill the virtue of giving in their children and the like. And what the ACE Act and what the Biden administration are supporting is that any expenses, whether they be compensation or travel expenses to meet with grantees, any expenses of a family member would not be included in that in those administrative expenses that help to draw down the 5% payout, which is, when you think about it, if you're a non-family member, all your expenses are treated as legitimate, so to speak. And if you're a family member, they're not. And I think the concern there is that it is a disincentive for sure for family members to work with in the family foundation, and I think that it provides some level of discrimination. There are plenty of rules that exist around self-dealing and around responsible and compensation. And I think this one hits family foundations raw. I think that the feedback we've gotten from family foundations is that this is just pernicious, and they're concerned that it could bleed into other areas. So, was there a second question?
I believe, did you answer how will distributions from a private foundation to a DAF be recorded?
So I think that goes back to the first issue of these restrictions on private foundations' use of DAFs. If a private foundation puts money into a donor-advised fund to meet its 5% payout, this legislation, how the Biden administration is treating it, would be disallowed. If it is not being used to meet its 5% payout, then it would be recorded as I think the phrase is, it's something distribution, it's adequate distribution or responsible distribution, but in other words, it's a good thing. So.
Got it. Thank you. The next question will be for Greg. Can a donor-advised fund be the beneficiary of a CRT?
A CRT, okay. Yes, a donor-advised fund can be the beneficiary of any charitable remainder trust. And this is a very common strategy, especially since many, if not most, charitable remainder trusts limit the range of possible remainder beneficiaries to public charities. And so a donor-advised fund would be a very suitable solution as a remainder beneficiary for almost any charitable remainder trust.
Excellent. And the next one can go to Jillian or Greg. What are the results of DAFs versus private foundations?
You want me to start off, Greg, or?
Sure, go ahead.
I guess I kind of took this question to be like, why a DAF versus a pre-F, and I guess, we can kind of there's benefits to both, clearly. And it really is back to what the donor wants to fulfill in its philanthropy, but also from a financial position as well. So, you know, we mentioned a few things. Control is something with the foundation. If a donor really wants to have full control over its grant making, full control over its investments, then a private foundation is probably a better vehicle. But if they don't really care and they go into, you know, different options in the investment world, then a donor advised fund is just fine, and they can recommend who they want to grant to. And to be honest, I can't imagine when they would say no, except if it was to a non-501c3 organization or a non-profit charity organization. So you should be fine with there, but that's different. Obviously, that there's a tax treatment that people kind of focus on, but I have to say in my career, I don't see too many people picking that up as being the determinator. I think flexibility with grant making. We deal with, you know, ultra high net worths, people who have huge foundations who want to do very sophisticated grants with, you know, significant impact. They want to control that. We went through a few of those program related investments, you know, DCAs, giving to individuals, whatever that is. And you can do that obviously more effectively with a private foundation. I think, you know, where I have seen with the DAFs from my perspective is, you know, if you know exactly who you want to give to, and you're very clear you want to give 3 or 4 grants a year, you're not looking for strategic advice around that, then the donor advised fund is totally perfect for that as well. And obviously anonymity, which I'm sure Greg could mention, is a huge attraction to a donor advised fund. And I think that's when we see, you know, reasons to have both, right? There is reasons to have both, and we see a lot of that where you have your private foundation, it's a public return. Everyone knows exactly who you're giving to, and if you want to give, you know, a bulk of your giving through your private foundation or a portion of, then you can have a donor advised fund to give to organizations that you don't necessarily want the general public to know about or attached to, and also stop people trying to, you know, going to you for unsolicited grant requests because you're now giving anonymously through your donor advised fund that you have. Exactly. You know, also where I see value to both is, you know, private foundation's mission is usually like fairly defined, but sometimes they set aside funds for those board members, as I said, to grant to individuals. And sometimes those gifts can go outside the mission area and it can cause some confusion. And then in that instance, I think it's really good to set up DAFs for those occasions. And each of them have their own DAFs, the money goes into it, and then they can deploy as they want. And then, of course, the big scramble at the end of the year can happen with a private foundation to meet that minimum distribution requirement that we spoke about. We see many of our foundation clients having a donor advised fund for that purpose. So they've made 4%, they haven't made the 5%, and they just donate the rest into their donor advised fund where they can let it sit for a while and make a decision about what they're going to do with their grants. So room for both, but really different vehicles. Greg, I'm sure you have something to add to that.
Well, I think you covered a lot of it, Jillian. I think you did it very well. But I come back to this slide as it was kind of co-commissioned by Foundation Source and us to go through the 7 major items. And it really comes down to the client's goals. What is the client trying to accomplish, again, with this stack of money from a flexibility perspective, from a privacy perspective, from a control perspective? Are they what many people would call the control freak? And are they the control freak so much that they're willing to have the lack of anonymity or lack of privacy that occurs with a private foundation? Or are they willing to scale back that desire enough that the privacy factor becomes such an important item for them that the donor advised fund is a better solution for them? Timeliness, certainly how quickly they need to get the charitable account created is another factor, but it's not the overall determinant factor. In both cases, there certainly is succession capability and ongoing legacy capability that exists in both cases, the donor advised fund and the private foundation. So again, it comes back to making choices, like a lot of other parts of life, making choices that the client will have to make in terms of where do they fit on these spectra and which one makes the most sense for them, the green or the blue, or both.
Thank you. The next question also for Jillian and Greg. Are you able to explain the individual tax benefits and disadvantages of DAFs versus private foundations?
Sure. Greg, you want like head off or?
I'll start off and then you can correct me. First of all, is the adjusted gross income limits from a tax deduction by an individual. And it depends on the type of gift that the donor is making, the amount of the gift that the donor is making. If the donor is making a $5,000 gift to an existing private foundation or an existing donor advised fund, the AGI limits are not applicable at all, right? Nobody's going to run into an AGI limit problem. On the other hand, if it's a $250,000 gift or a $30 million gift, then the adjusted gross income limits might become a much bigger issue for that particular client. So the amount of the gift, but also the type of the gift. If the client is making a gift of cash versus a gift of, let's say, a piece of real estate, we've got $1 million piece of real estate that has a $100,000 cost basis. For a gift to a private foundation, their deduction is going to be limited to $100,000. And then we have to go through the AGI limits. On the other hand, a gift to a donor advised fund of that $1 million property, the $1 million deduction is the first number that then has to go through the adjusted gross income limits. Also, from a tax perspective, Jillian mentioned earlier the tax on net investment income for private foundations. It's 1.39%, a very minimal amount, but it does exist in the private foundation world and does not exist in the donor advised fund world. We've mentioned a couple of times different excise taxes or types of excise taxes. As a general rule, there are fewer excise taxes that apply to donor advised funds, and they also tend to be generally less prohibitive for donor advised funds than they are for private foundations. And I'll just give one quick example, self-dealing versus excess benefit. In the world of private foundations, self-dealing is the phrase that is used for something such as the donor buying back the assets of the private foundation. That would be an act of self-dealing. There are various taxes that apply. On the other hand, if the donor buys back the assets of a donor advised fund at fair market value, then it's an excess benefit calculation. And so long as it's for fair market value, there is no excise tax. And so there's an example of a less prohibitive excise tax for donor advised funds compared to private foundations. Jillian, anything else to add?
No, I think, there is differences in terms of the percentage limitation under the AGI and more favorable in general towards the donor advised fund for sure. I think there's going to be a question about appreciated stock, and so it's up to 30% AGI in a donor advised fund, 20% in a private foundation. So it's stuff like that. I don't see, we have very few, certainly up to 60%, unless they, maybe have a big sale of a business that day or that year, like you said, Greg, but I don't know, too many donors use up to 60%, and I don't know whether too many of them use up to 30%. So sometimes that doesn't even necessarily come into play, but they all have a deductible amount and a percentage limitation, and it definitely favors the donor advised fund in that area. We could go through every single one of them, but I'm not too sure people want to listen to that.
Let's move on to the next one then. The next question is, can you determine which of the two is a better option?
Well, I think we've kind of touched on it, where it really is just dependent on what's needed. Financially, obviously, if you look at a donor advised fund, you can enter them sometimes for $25,000. And that's obviously can be something that influences whether you pick a foundation or a donor advised fund, because you're not going to start a foundation for that amount. But I will say what I think is off the table, especially if you're working with an organization like Foundation Source, is that amount doesn't really matter. We open foundation for $250,000. We open them for $1 million. We open them for $50 million. And I think you could probably do the exact same in the donor advised fund. But what I'm saying is that if you align yourself with a sponsoring organization like Foundation Source, who's going to take all of that burden of setting up that foundation off of you and can set it up in a week and have you grant making it the minute you fund, then it takes away that kind of complexity, that burden, that kind of, people shying away from it. because somebody else is taking it on, and you have all the access with an organization like Foundation Source to legal and compliance immediately, to taxes, filing the tax return, which is a complex thing as well, financial accounting, and of course, constant service and helping you make those grants and advising you on those grants. So that's that end of the spectrum, and then the donor advised funds. But I think there's absolute room for both.
Perfect.
Yes, I would agree with that. And I would say that there are donor advised funds. We certainly have some donor advised funds where people can make a contribution as little as $1 through the workplace giving options. And so those are certainly an option that are available to if you search for them. And again, it comes back to what does the client trying to accomplish? At its core, both the foundation and the donor advised fund allow the client to claim a charitable deduction of some amount or money that's irrevocably committed to charity forever. And so it's just a question then, which one of these makes the most sense? From a deduction perspective, I was remiss in mentioning that, as an example, gifts of art. Someone has art that they want to make a gift to either their private foundation or their donor advised fund, both from a tax deduction situation are treated essentially the same, cost basis deduction for both. So another example of the different types of assets that might be given. And it really comes down to, again, what is the client trying to accomplish with their particular charitable gift?
And with that one, Greg, too, that's a good example, because I think, generally speaking, then with the donor advised fund, you're going to have to sell those assets to liquidate those assets eventually. Whereas with a private foundation, you can keep them as is. And that can be attractive too.
Yes.
Thank you both. I think that was a great explanation. Sandra, I have a question for you now. Can you please assess proposed legislation limiting DAFs and how a DAF can be used in conjunction with a PF?
Sure. So I'll start with the first one, and that is the assessment of the legislation to reform donor advised funds. I think probably known as the ACE Act. And I think that right now there is not a live bill in Congress. There was a live bill in the last Congress, so a year or so ago. And the opponents of that bill from the sector, I think, helped to squash momentum for that legislation. All bills at the end of the session die, so it has to be reintroduced. And so far this year, the bill's not been reintroduced. It doesn't mean it can't be between now and the end of next year, or it won't be. It just means it hasn't been yet. And I think that what that suggests to me is that the supporters of that bill acknowledge that in its present form, we like to say in Washington, it doesn't have legs. It's a non-starter, right? DOA. However, the supporters behind the ACE Act, including patriotic millionaires and some very well-funded donors, I think have not stepped away from their campaign to reform donor advised funds. Question is, what is their next step? And my bet is that their next step is going to be something far smaller, far more targeted than the ACE Act. And I think we are likely to see something next year. And the reason I say that is because just in the past couple of weeks, in a lot of our, quote, cultural publications, things like Rolling Stone magazine, Teen Vogue magazine, the issue of DAF reform has popped up. And that may seem incredible, but the supporters of donor advised fund reform have now turned their attention away from lawmakers and are now trying to influence through other more cultural publications. And so I don't think that they have gone away. I just think that they are recalibrating their campaign, maybe for next year in the midst of a big political season, or maybe for 2025. And I do want to say one word about 2025. In 2025, we have two huge events in tax world, which we all pay attention to. The first event is that at the end of 2025, all of those tax cuts that we got via the 2017 tax bill expire, and all of those tax rates snap back to what they were prior to the 2017 tax bill. So that's the first event and development that a lot of us in tax world pay close attention to. The second one is that the country's going to once again meet its debt limit. And what the debt limit is basically the country's credit card limit. We are bumping up against it yet again, and we're going to bump up against it in 2025. Between the debt limit, which is always a very difficult vote, and it's always very combative, and there's a lot of side deals with horse trading. Between that and the decision, the debate, whether to extend some or all of the tax rate cuts from 2017, that's all going to take place in 2025. We will start hearing about it in 2024 because they're great political issues, but we will absolutely be dealing with them in 2025. And I suspect that is exactly when the supporters of the ACE Act we're going to start hearing from them loudly and proudly. So that was the first question. And the second question, I'm sorry, Anna, I forgot it.
I can read it again. It was how a DAF can be used in conjunction with a private foundation.
Okay, that is outside of my skill set. I'm going to turn it over to Jillian and Greg.
And I actually gave a good few examples of that already, so I'm not going to repeat that. But yeah, there's many ways in which we can use both. I just spoke about that, so I think it's good if we can.
Yeah. Okay, we can move on. I think we have time for one or two more questions. Greg, is it possible for you to walk us through a typical gift of S Corp stock to a DAF?
Sure thing. So the donor advised fund sponsoring charity will need to perform due diligence on the company, which will include at a minimum a review of the company's governing documents, such as the articles, the bylaws, and any existing shareholder agreements. Also, recent financial statements will also need to be reviewed of the company. Now, for an S corporation that's owned by a donor advised fund or a private foundation or really any charity, for an S corporation that's owned by any charity, including a DAF or a private foundation, all of the net earnings by the S corporation attributable to that charity's ownership interest will be considered unrelated business income to the charity. This includes all dividends and all interests and all net capital gains, as well as any phantom income allocated to the charity. The donor, on their side, in order to claim the charitable deduction, they'll need a qualified appraisal of what they gave to charity. So if the donor gave a 10% interest in the company, they'll need an appraisal of that 10% interest, not an appraisal of the entire company, but an appraisal of that 10% interest, which may or may not include discounts for minority interest and the like. If the deduction exceeds $500,000, then that qualified appraisal will need to be attached to the tax return claiming the deduction. So if you think of an individual making a gift today, October 24th, 2023, an individual files their tax return, it's due next April 15th, they'll need to have a copy of that qualified appraisal attached to their tax return if they're claiming a deduction in excess of $500K. And that particular charitable deduction is claimed by using also IRS Form 8283, which also needs to be attached to that tax return, the 1040 next year. And that needs to be signed by the appraiser who made that qualified appraisal, as well as by somebody representing the charity that made the gift, or that received the gift. And then when the charity, we'll use the donor advised fund in this example, sells any or all of the gifted asset, the charity needs to file its own form, IRS Form 8282, reporting that to the IRS if it's sold within the 3 years after the date of the gift. So there is due diligence that needs to be done ahead of time. And in some cases, it's really a dating relationship on both sides. The S corporation governing officers and board of directors need to determine, are we comfortable with this charity becoming a shareholder of our organization? It's very likely that the charity will be a shareholder for a few months or maybe a couple of years even? And are they comfortable with this charity becoming a 10% owner, 2% owner, or 7% owner of this company for the next X number of years and participating in board meetings? As a shareholder, if there's a shareholder meeting, then there needs to be notice now sent out to this other charity, this other shareholder, which may be quite a culture shock for some S corporation owners.
Thank you, Greg. And on that note, I'm afraid that we've run out of time, but I'd like to thank our speakers, Jillian Howell, Sandra Swirsky, and Gregory W. Baker for an outstanding presentation. We would also like to thank Foundation Source for sponsoring today's forum. We would also like to invite all of you back to check out all our other upcoming virtual forums that'll be taking place. Click on the upcoming forums widget located on the bottom of your console. Once you leave the event, a short survey will pop up in your browser window. We'd appreciate it if you share your feedback on this event, as it helps us to provide you with content most interesting for you. On behalf of Trusted Estates and Wealth Management, have a great day.